Is the font large enough to read? Perfect. All right. There we go. So when we talk about comprehensive tax planning, there are really 3 points in time that you get hit with tax. And what we try and do is we try and work on um, either timing or investments or structuring your activities in such a way that we reduce that taxable income at those 3 points in time. Today, I'm going to be talking about reducing your tax burden now meaning 2024. We also have things that levers we can pull to reduce taxes at retirement and reduce taxes. And we say it very nicely on this page at the transfer phase, but really what that means is at your death. Um, but when we reference comprehensive tax planning, those are really the 3 points in time that you get hit with tax, and the 3 points in time that we focus on reducing your tax liability. Now, having said that, the fourth thing that we do when we think about comprehensive tax planning is identifying tax trends and opportunities. And tax laws can change for any number of reasons. Congress could issue or pass new legislation. The IRS could issue new regulations, or a court could interpret either of those two things in a different way. But we track all of that stuff because anytime there's a law change, there can be risks and there can be opportunities. So we like to focus on the opportunities and steer our clients away from the risk. So having said that, when we think about our advanced tax reduction strategies, there are really generally four buckets that these things naturally fall into. The first one is recategorizing income or loss. So as an example, from a passive loss to an active loss, ordinary income to capital gain income, etc. Retirement planning, tax efficient investments, and I've got two of those I'm going to walk you through today. And then this last one, recapturing the lost tax dollars. Now, sometimes that can be as simple as us amending prior tax returns to take a deduction that was missed. But I don't want to mislead you. Rarely have in fact, never have I seen a material amount of money saved through amending a tax return. Um, the other thing we can do is we can take a look at past deductions, and if there are many of those, one of the things that, depending on facts and circumstances, we may be able to do is run the cumulative effect of all those missed deductions through your current tax return. Again, depending on facts and circumstances. So that's kind of what we mean when we say recapturing the lost tax dollars. So presentation today, the one with an asterisk, I'm not going to cover. It is our 3D asset allocation strategy, and that is the basis for our wealth management team. For them, they focus on people with portfolios of 5 million and above. If it's something you're interested in, at least talking to them about, I'd be happy to set up a phone call. Andrew, maybe it would take him a half hour. He can walk you through what that is and how it works. And, even if you don't use our wealth management, maybe you could apply it in your own investments. But having said that, I don't even do my own investments at home. I'm the tax guy. So I'm going to draw the line there and stop talking about investments. The next two, it looks as though my notes indicate that you do not have an umbrella insurance in place. And really, all umbrella insurance does is it sits on top of you typically have auto and homeowners insurance. The umbrella insurance just sits on top of those. And what it does is it protects you. If ever there's a claim that exceeds the limits on your auto or homeowners, that umbrella insurance kicks in and will help defray additional cost. And we always recommend to our clients to get that umbrella insurance. Most of our clients have significant wealth, and as we start saving you money in terms of tax, that wealth is going to start ballooning. And unfortunately, kind of the nature of where we live, that makes you become more of a target. If God forbid, one of your kids behind the wheel of a car backs into a Lamborghini and you become defendant number one. So having that umbrella insurance is really, really valuable. The easiest way to get, we don't do anything with it ourselves. The easiest way for you to get it is just to call your auto or homeowner insurance agent. Typically, it's the same company, and just ask for a quote for umbrella insurance. They typically come in $1 million increments, and it's very inexpensive because again, most of our clients are adequately insured to begin with. So the likelihood of ever using that umbrella insurance is minuscule. So when you get a quote, it's usually pretty cheap. I had a client in California get $5 million policy for $800 a year. Um, so well worth doing. How old are your kids driving it? Yeah, once they start, yeah, and that's just from personal experience. I was so happy to have an umbrella insurance when my oldest daughter, um, she's now 23 and has been safely driving for a number of years, but she totaled four cars by the time she was 17, two of which we owned. Um, Fortunately, nobody was hurt, but just having that umbrella insurance in place, lets you sleep easy at night. So we'll check that one off. And in fact, and I'll send you this presentation when we're done. Um, woo, let me make it legible here. Woo, there we go. The next piece is estate planning. You don't have a will and trust in place currently, is that correct? Yeah, so good time for me to introduce it. Our personal CFO services, which is what I'm pitching you today. They cover really three things: estate planning, and for most of our clients, we say estate tax, but really, for most of our clients, the tax piece is not an issue. You and your spouse, assuming you have a properly structured will, can pass 26, 20, almost $27 million without any estate tax ramifications. So for most of our clients, it's more estate planning and less tax planning. Having said that, if Congress does nothing, that $27 million drops to 12 million on January 1st, 2026. So maybe you don't have an issue. Sure. Yeah. So currently, with a properly structured will, it's a will with something called a pour over provision. You and your spouse can pass approximately $27 million without any estate tax ramification. If Congress does nothing, that exemption provision automatically reduces such that that 27 million goes to 12 million on January 1st, 2026, if Congress does nothing. Now, I would never do today based on what Congress may or may not do in the next year. Our estate planning attorney, he's already got roadmaps in place for what we need to do for clients in different buckets. We'll know by April, May of 2025 if Congress is going to do anything or nothing. Typically, anytime you have a presidential election, if there's going to be any significant tax legislation, it's typically in the first 4 months of the new administration. And so we'll know pretty quickly if they're going to do something or nothing. But having said that, even without tax in mind, you really should have some estate planning done. And like I said, our personal CFO services cover estate planning, tax return preparation. The estate planning is really, it's almost worth the price of admission. Our fee is a flat $15,000 a year, no matter how much we save you, $15,000 a year. Again, estate planning, tax return prep. The estate planning piece will typically include both a will and a trust and other ancillary documents, healthcare directive, durable power of attorney, et cetera. But it's that will and trust combination, I think, that works well. So when you die, there are two ways for your assets to pass. One is by contract. A good example, it would be you've got a 401k, right? Or a 403b, something like that. You've got probably your wife designated as beneficiary. That's how assets pass by operation of contract. There is nothing that needs to happen that as soon as you die, that those assets transfer to your beneficiary. Likewise with life insurance, you've got a beneficiary. As soon as you die, that money gets paid out to the beneficiary. That's what's called operation of contract. Now, for things that don't pass by contract, there's what's called operation of law, which means a court, typically a probate court, will look at all of your assets that are not passing by operation of contract and apply, if you don't have a will, apply the state law to figure out who those assets go to. If you do have a will, it does the same thing. They will look at all of the assets and figure out who they pass to by using the language of your will. Now, that uh, so typically homes, cars, if you don't have a beneficiary on your brokerage account, uh, occasionally you'll have checking accounts or IRAs where maybe you forget to put down a beneficiary, those types of things, personal property, etc. So what lawyers have done is they have created something called a revocable trust. And really all you do is you title those assets in the name of the revocable trust. And so, for example, your house and cars could be titled in the name of the revocable trust. It does nothing from an income tax perspective. It does nothing from an estate tax perspective. But what it allows you to do is bypass probate because those assets now pass by operation of uh, contract, right? The assets are titled in the name of the trust. When you die, they just go to whoever you designate in the trust. And what that allows you to do is bypass the very cumbersome probate process with as much stuff as you can. Now, you're still going to want a will because even if you title absolutely everything in the name of the trust, the will does two things. Maybe you acquire an asset after that and you forget to put it in the trust. But the other thing a will can do that a trust cannot do is designate the guardians of your children. And that is particularly important. You've got some younger and some older, but um, it's a very important provision. And our estate planning attorney is very good. He'll walk you through. He'll sit down with you, figure out what you have and where you want it to go, and uh, draft the appropriate documents. The one thing we cannot do, however, because we're not a law firm, is send you the final documents. We have to send it to a New York law firm for them to bless. Now, fortunately for us, our estate planning attorney, and he'll never forget his name, T.L. Turnipseed, um, the estate planning attorney, he taught as a tenured professor for many, many years at the Syracuse Law School, where he taught trust and estate. So he's got students all over New York, well, really all over the country, but he'll just reach out to a student who will give him a special rate. They'll spend maybe an hour looking at the documents. They'll bless it from a legal perspective and send it off to you. That way, we avoid the unauthorized practice of law in New York. Now, both TL and I are licensed in New York, but Neil Jasani Advisors is not a law firm, so we can't although we can draft this stuff, we can't give it directly to you once it's finalized. So estate tax, check. Now comes the two pieces that I think where we can impact your taxes this year. So, like I said, typically the first year, most of our time is put in terms of the estate planning. So we don't make a ton of money on the first year. So my job as the tax guy is to save you an obscene amount of money to bring you back for year number two, because that's when we actually do have a little bit of profit built in. So having said that, let me just talk to you about the two pieces that I think two levers we can pull in 2024 to save you some money. The first one is what's called an in-kind charitable donation. Now, in-kind simply means non-cash. And do you need to switch to your computer or? Oh, well, no, okay. Well, the other thing you could do is turn on the video on your computer and listen to audio by phone. Just throw that. Well, you let me know because some of the numbers might get a little small. I will try not to. I will try to expand my screen as much as I can. You let me know. In kind simply means non-cash. And with a non-cash donation, there are really two big rules that come into play. The first of those rules is the most you can deduct in any year is 30% of your adjusted gross income. Now, typically, your adjusted gross income is typically your W-2 amount. Now, my notes indicate you're expecting your W-2 amount in 2024 to be approximately $1 million. What your W-2 is 1.2? Okay. Do you have any other income? What is the yeah, what is the nature of your other income? Hmm. Oh, neat. So it's probably 1099. Is it like 1099 income? How much do you expect that to be for 24? Okay. All right. Okay. Excellent. And do you have any expenses associated with that, or is it just typically 1099 income and that's it's for your time and that's about it? Hmm. 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 Got it. Hmm. All right. Hmm. Right. So you only drive to or from the conferences? Uh-huh. Hmm. All right. Excellent. Um, so here's the rule. If you use it more than 50, you got to track your mileage first. Um, oh, I see you're entering the waiting room. I apologize. I think you're joining. There we go. So if we get an echo, I'm going to stop talking, and we'll have to mute one of your two devices. Yeah. Okay. Sure. Okay. So the rule is this. You're supposed to keep contemporaneous mileage logs. So if you've got a mileage log associated with um, uh, use of that vehicle, then you're good. Then that you're checking the box on the first part of the rule. The second part of the rule is your business mileage has to be more than 50%. And so long as your business mileage is more than 50% of the total miles driven, you're able to take a deduction. Now, if it's 100%, that's easy. Then you get the depreciation you would normally have taken. If, for example, your business mileage was 75%, then you would get 75% of what you ordinarily would have gotten on depreciation. And the depreciation on the automobiles is kind of a sliding scale. Uh, it is what's called listed property. I would have to take a look. Um, Prior to 2023, you could take 100%. In 2023, I think there's an additional limitation in terms of the total depreciation you can take. But we take a look at it. It would either be section 179, in which case you might be eligible for up to 100%, or section 168K, which is what's called bonus depreciation. Um, yeah, so we would take a look at it and apply the limits. Um, yeah, yeah. So yes, if yeah, you may be one of the. I It probably doesn't surprise you. I do have a lot of doctors' clients, and um, oftentimes I have to have very difficult conversations. I had a gentleman who bought a 6,000 pound, $350,000 Bentley, and he wanted to expense it. I said, "Well, here's the problem. You have a single office. I don't know how often you go to Office Depot to buy supplies, but this is just not going to work. It doesn't even meet the smell test." So those are difficult conversations I have to have. The fact that you're using it just to go to conferences, I think is that's great. Those are great facts to have. The other thing to think about when whether you use us or continue on your own, the fact that you have so your profit's about 100 grand a year after expenses. Hmm. 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 Yeah. Hmm. Hmm. Well, yeah. Well, here's where I was going with that. If it's net of 100, if it's net of close to zero, then probably not worth talking a lot about. But if it's close to 100, all right, then there are a couple other things you ought to think about. Are your kids working at all? Not the obviously not the younger ones, but so one of the things you can do, and I would encourage you to think about it. What you could do is give them tasks to do as part of your work. Um, Tracking your mileage, um, dividing out your home expenses to allocate the portion to your home office, do the accounting, do internet research for you, um, draft emails or do marketing, any number of things. But what you could do is pay each of them $7,000 to do this stuff. And this is a Rich Hoffman rule of thumb. It's not an IRS rule, but the Rich Hoffman rule of thumb is you've got to have a job description associated with what you're paying them for. And they have to be old enough to actually understand the job description. Assuming both of those boxes are checked, I would pay each one of them $7,000. I didn't pick that out of the blue. You could pay them up to $14,000 and they wouldn't have to file a tax return. But at $7,000, What they're eligible to do at that point is contribute the maximum $7,000 to a Roth IRA. So essentially, what you've done is you've taken a non-deductible retirement vehicle and you've turned it into a deductible IRA because you're getting the deduction on your tax return for business expenses. And your children don't have to file an income tax return, but they have enough earned income to support the full IRA contribution. So I'm just throwing that out there. It's not, it's excellent. Oh, that's fantastic. That's holy cow. Holy cow. Start paying them. That's awesome. Well, yeah, right. Yeah, so you can go ahead and do that. Fun stuff. Or you could do it, $14,000 each, have half of it go to the IRA and have them put the other half in the 529. More than 14, they would have to file a tax return. Less than 14, they don't. That's the threshold. No, no. Oh, well, what I would recommend them do is put a 7,000 in the IRA and have them put the other 7,000 in a 529. And you've turned your part of your 529 contribution into a deductible 529. Yeah. Just don't once you exceed that 14,000, they'll have to file a tax return. And the other downside is you would have to issue a 1099 to them, which isn't it's not the end of the world. There are a number of online services that might cost you $3 per 1099. It's really cheap to do it online. They'll file with the IRS electronically. That it'll automatically generate the 1099s to be sent to your kids. It's very seamless, very easy to do. Sorry, I got sidetracked. The in-kind charitable donation, and here's how the strategy. Let's say what we talked about. We talked about the 30% limitation. The other, I told you there were two rules. I only discussed one. So there's a 30% limitation. So as an example, if your AGI was 100,000, your limit would be $30,000. If you donated something worth $50,000, then again, there would be a cap on your donation deduction of 30,000. That $20,000 difference doesn't disappear. It actually carries forward for up to 5 years. So, in other words, you've got 6 years to use that tax deduction. The year of the donation plus the next five. And again, year of donation and each of the succeeding years, your limit is 30% of your adjusted gross income. The second big rule that comes into play is if you donate something that is long-term capital gain property to a charity and the charity uses it as part of their exempt purpose, then you're permitted to take a fair market value deduction. Now, usually at this point in time, whoever I'm talking to on the phone is a little concerned that Hoffman's going to talk them into getting rid of all their stuff. And while donating all your stuff to charity is certainly a viable tax strategy, most of our clients like to keep their wealth. So that's how we've designed this strategy so that you actually do keep your wealth. So let me kind of walk you through how it works. So um, uh, we have a vendor that we have used for the last 5 years, and they have been doing this much longer. What they do is they buy minerals in bulk. So as an example, last year they bought volcanic ash. They put this mineral into a limited liability company. They will then sell you an interest in the LLC. And the purpose of the LLC is to donate the minerals to a qualified charity that will use the mineral as part of their exempt purpose. So when you buy that interest in the LLC, there are two things that happen immediately. They have what's called a preliminary appraisal done. And that simply will tell them the value of the mineral in their LLC currently. And they look at that value and they look at all of their all of the people who have invested. And what they will do is they will, based on that preliminary valuation, they will put additional minerals into the LLC to bring that fair market value up to the point where your portion of the fair market value deduction is equal to 4 times what you have purchased your interest for. So, and I believe these are roughly your numbers. So if I were to put your numbers to paper, your adjusted gross income is approximately $1.3 million. That tells me your maximum deduction amount is 390,000. Now, to get that maximum deduction amount, you would want to buy $97,500 worth of LLC ownership interest. Now, the timing of this is such that they open this up for investors typically in November. So usually what we do is we track clients that are interested in this, and we'll send everybody a note towards the end of October saying, hey, it's time. Let's sit down and talk about this because, right now on April 15th, you think your AGI is about $1.3 million. By November 1st, you're going to have a more exact number. You're going to say, gosh, Rich, those kids, they ate up all my profit. It's zero or something like that. Um, so you'll know on or about November 1st. We'll refine these numbers again with something that's a lot closer. But 1.3 million is not a bad ballpark. So November rolls around. We'll do the calculation. If it's something you decide you want to do, we put in $97,500. And at tax time, you get really two documents. And you know what? I take that back. Um, New York has a 50% limitation. So let me just tweak my formula here. Um, Sorry about that. New York's going to give you a 50% limitation on your charitable donation. Um, Still not a bad number. So what happens is at tax time, you get 3 documents. You get Form K1, which is what a pass-through entity sends to its owners. Your Form K1 will only have 2 numbers. It will say you put in $97,500 and your portion of the LLC's non-cash donation to charity at fair market value is $390,000. The second document you receive is Form 8283. That document is going to list the charity's name, address, federal ID number, and most importantly, they sign it, certifying that uh, they're using the mineral as part of their exempt purpose. The third document you get is you actually get the qualified appraisal. So what we do is we attach that Form 8283 and the appraisal to your tax return, and you're able to take a deduction of $390,000. Now, at various limitations, that $390,000 deduction will reduce your taxes by $157,000. Now, we haven't saved you $157,000 because it's cost you 97,500 to buy into the LLC, right? So your net savings is the difference between your savings on tax less what you've already paid. So really, we've saved you about we'll call it $60,000. So maybe said in a different way, you should have about $60,000 more in your checking account after this transaction than before. So last so no, none of that. Last year it was volcanic ash, and the charity they chose. And you're more of a science guy than I am, so you may get a kick out of this. The charity they chose was a charity called Bread for Haiti. And first thing out of my mouth is, well, that sounds like a really bad dinner, right? Volcanic ash. Uh, but as explained to me, and I use Google to double check, volcanic ash, when mixed with the soil, produces more productive crops. So what the charity has done is they've transferred this mineral to the farmers in Haiti. They're mixing it with the soil, should produce more productive crops and make them less reliant on foreign food aid. So, you know, as far as tax strategies go, you know, doing something good and getting a deduction is probably, you may be in this just for the deduction, but you're also doing something good. Um, and usually that so part number two is this is kind of a one and done. So you get the documents at tax time, and at tax time typically um, right around April 1st to April 15th. Sometimes they're a little bit earlier, sometimes they're a little bit later, but usually you're filing your tax return typically April 15th to April 30th, and 2 to 3 weeks later you're going to get your refund. Um, and then what happens is uh, on or about November 1st, 2025, we'll have the call again. We'll figure out what your income is for the year. You'll figure out how much you want to do, and you can rinse and repeat. They'll have formed a new LLC. They may use a different mineral. They may pick a completely different charity. Um, but yep, it does. The charitable donation deduction is an itemized deduction. So it will show up on Schedule A as an itemized deduction. So if usually the big question I get asked is, hey, Rich, what are the tax risks associated with this? And if I were to put my IRS hat on, um, there are things the IRS simply can't question. They cannot question the fact that it's a charity because they're listed on the IRS website. The IRS has granted them charitable status. Um, they can't really question the fact that the charity is using it as part of their exempt purpose. A, because they've signed that they are, but B, if you look at the totality of facts and circumstances, what else are they going to be doing with this volcanic ash other than doing what they're doing? So it kind of makes sense. The IRS really isn't going to question that. If they're going to focus on anything, they're going to focus on the valuation. And, there is tax risk associated with the valuation. Now, having said that, this will be our 6th year doing it with clients. We have not had an IRS adjustment yet, and I know that's anecdotal evidence. But um, if I were to look at maybe a risk spectrum in terms of valuation, could you do this with art? Yeah, you could donate a piece of art to an art museum and take a fair market value deduction. But um, you donate a Picasso to some museum in New York City, yeah, you're going to get a deduction, but you could get 10 appraisals and get 10 materially different numbers, right? I mean, we've all seen Antiques Roadshow, right? I mean, who knows? Uh, the same thing is true with real estate. Real estate, you could do similar things, um, but each one is unique and different. At the end of the day, it's worth whatever somebody's willing to pay you for it. So at the low end of the spectrum, if we were just to use the same charity as last year, if they donated corn, that would be at the bottom. And the reason that would be at the bottom is A, it would fill, the charity's defined purpose to feed the people of Haiti, but B, we'd know the exact quantity that they contributed. We'd just simply look on the Chicago board, see what it was trading at. We'd know the exact fair market value without a question. We wouldn't even need an appraisal. So I would say the mineral, I would say it's not without any risk, but it's certainly nowhere near art or real estate. We're talking pounds of volcanic ash. In my mind, we're closer to the bottom than we are to the top. Um, but again, you know, it's not without any risk, but certainly I would say there are other things the IRS are focusing on in terms of valuation. You are buying an LLC interest. The LLC holds the mineral, and then the LLC donates the mineral to the charity, and you get your portion of the LLC's deduction. So the other piece to keep in the back of your mind is in terms of audit risk, we're in what's called a unified audit environment. And what that means from an IRS perspective is they are required to audit the LLC. They can't audit you for this transaction. And the benefit you get is A, they're auditing the LLC, but they're also auditing, the LLC that's received $500 million of volcanic ash or whatever mineral they're going to use for 24. $500 million of that stuff. There are 10,000 owners. So that rule was put in place really to preserve IRS resources. They can audit 10,000 people or they can audit the single LLC. So they're going to audit the LLC, but um, the bulk mineral company that has the wherewithal to buy these minerals and put it in and orchestrate this transaction are also going to be the ones on the hook for defending the audit. And they do dot their I's and cross their T's. They do focus an awful lot on the valuation. They make sure that whatever they have, it will withstand audit. All right, so that would be transaction number one, which could save you, get rid of the noise, as much as we'll call it $60,000. Transaction number two is an equipment rental strategy. There are a few more moving parts with the equipment rental strategy, but um, should be relatively straightforward once we get it in place. So with the equipment rental, the first thing we would do is form a limited liability company. You would own it, and it's not just equipment, it is construction equipment. And the construction equipment industry in the US is a $60 billion industry. And there are a lot of mom and pops, but there are three big players. And the smallest of those players is trying to rapidly gain market share. They're doing it by putting their own equipment in different locations throughout the US, but they've opened this strategy up to people like you and people like me to buy equipment, put it into their program, and they will handle the rental. So they will do a number of things. They'll do all the maintenance. They'll move the equipment to wherever it needs to be. They'll handle the property taxes. They will collect the sales tax if applicable from the end user. They'll make sure the end user is trained and has insurance. They will keep their own insurance. Essentially, it's turnkey. Uh, from that, they will share part of their revenue with you. What makes this a tax strategy, however, is that construction equipment is eligible for something called bonus depreciation. And this is bonus depreciation under section 168K. So roughly, well, exactly 60% of the value of those assets placed in service is eligible for depreciation in year one. Now, what makes this so attractive is that in order to, well, typically year one is where you get a very large deduction. That deduction is only usable by you if you meet the material participation threshold for a business. And that material participation threshold is 100 hours. So over the course of 2024, you or your spouse will need to track their time and put in 100 hours. Now, that 100-hour requirement, the technical rule is it's under the regs under section 469. So if you type in 1.469 and business participation requirements, it'll give you seven rules. Really, we're just looking at the one that requires the minimal amount on your part. And the rule is that you have to put in 100 hours and nobody else can put in more time than you. Well, what happens is the equipment rental company tracks all of their employees' time and will give you a certification at the end of the year saying, hey, we've tracked all of the employees' time. We spent less than 100 hours on your equipment. Why it works particularly well, let me move this over here, is I think we can generate a sizable deduction for you. So um, you'll see I have a really tax wonky calculation up here. Don't focus on the calc, focus on the amount. What I'm trying to do is figure out what the optimal cash outlay for you is in year one, year 2024. That would be $134,357. Now, why it works well is you would put in this money, you would borrow money, and this is truly borrowed money. There would be debt service on this. However, you can see my assumption. I have an assumed bank rate for the debt. I have 9%. Truth be told, the last four people have come in at just under 8%. I would expect you to be about there. However, it almost doesn't matter because your debt service costs are zero. Because when we look at the revenue share lines, there are really two components to the revenue share. The first component is on the debt service. So they will pay you dollar for dollar. The money will come into your account, then it will leave your account and go to whoever holds the note. But if we were just looking at debt service, your cash flow would be zero. The second component of this is, and this is where there is true cash coming into you, is they are paying you on an annual basis 10% of the amount of money you put in, right? So I've got 3/4 of the year in 24, 1/4 of the year in 29, but truth be told is probably 50% here and 50% here. But on average, $13,000 a year. They'll pay you monthly, but annualized, it's 10% of the cash you put in. The cool thing about this, however, is you get this big bonus depreciation in year one. And you get the normal regular depreciation on what isn't subject to bonus depreciation. So in year one, you get a deduction, federal deduction of $569,000. Now for New York, New York does not believe in bonus depreciation. So your deduction would only be 117,000 for New York in year one. Now, the downside to this, if there is a downside, the downside to this is you'll see in year five, we've got this big income pickup. Now, the reason we have this big income pickup is from you in year five, and they have a minimum purchase price. That minimum purchase price is going to be whatever's left on the debt. So in this case, 403,000 plus they call it minus a fee oh they're buying this equipment back from you. And the minimum purchase price is going to be whatever's left on the debt. In your case, the minimum purchase price is $492,000. They're paying you what's left on the debt plus an investment amount. And this investment amount is going to simply be, it's a calculated number. It's the amount of cash you put in minus a fee that they charge on the front end, but you really never see it until the back end. They charge a fee of 5% of the value of the equipment placed into service. So in other words, of this 134 you're putting in, you're receiving 67,000 ratably over the course of 5 years, plus 89 at the end of 5 years. Now I know 89 and 67 is more than 134. You're getting a little bit more back than you put in. But in essence, it's kind of a zero-sum game. You're getting a big deduction in 2024. That big deduction, and again, I apologize, I'm gonna have to change my formula here again. That big deduction. That so that in year one, that big deduction, so 130, it's kind of the same calculation we just did. You put in 134,000, it's going to reduce your taxes by 218,000. So the year, and again, this is just a tax snapshot, right? Your year one cash savings should be about 84,000. Now, keep in mind, you are still getting the 134,000 back over the course of the next 5 years. But $84,000 savings in year one. The other phenomenon is if you still wanted to do the charitable donation after you're doing the equipment rental, you'd need a lot less because we've reduced your adjusted gross income from $1.3 million to $731,000. And that reduces your benefit. Now, still at 54,000, you're still saving 84, right? Your net cash savings, same calculation, amount of it. Correct, correct. So if we say the low end is 60, if you wanted to do both together, we could save you, we'll call it 110. Now, having said that, let me know when you're ready for a curveball. All right. So here is uh, here is the curveball. Um, so we're currently looking at $134,000 to get you a $569,000 deduction. There is currently legislation that is halfway through Congress. The House has passed it, a vote of, wasn't even close. It was 350 to 70. So what wasn't a real close vote, 350 to 70. And part of that legislation, it's mostly tax driven. The Republicans will call it the business tax bill. The Democrats will call it the child care tax bill. Both of them have things they like to hang their hat on. Um, so with a largely bipartisan majority, they were able to pass it. We're waiting on the Senate to do something with it. If the Senate does decide to pass it, I have no doubt the president will sign it. He needs a win worse than any president we've ever seen. Um, what did it does many things, but the thing we're concerned most about is this bonus depreciation. It changes it retroactively from 60% to 100%. So to get that $569,000 deduction, it doesn't cost you $134,000. It costs you $87,000. So you can get the same benefit with a lot lower price tag, and we could call that 8%. Um, so what that does, and I apologize, I'm gonna have to change my formula again here. Hold on. If I can do it like this. Yeah, there we go. So what that does is you essentially get roughly the same savings, a little bit less for New York, roughly the same savings with a smaller amount of investment. So your cash benefit is 150, call it 155,000. So what I would say is at the low end, we're at 60, probable end of about 115. And we got to rely on Congress to do something. We're at about 100, call it 155. So I would say this would be the outlier. But, one of the things I would say is if you came on board as a client, um, you know, this equipment rental it's not for the faint of heart. So, what we do is we give your name to the equipment rental company, and they'd unload. They give you access to a bunch of legal documents. It's going to take you time to look through those legal documents. Hopefully 100 hours. It'll take you some time. You track your time getting through those legal documents, and by the time you're done, you'll have a bunch of questions. We'll set up with some phone calls with the equipment company. We'll walk through those questions. You know, I'll attend those calls with you. We'll follow up with an email to the equipment company. Hey, this is what we understood from, these are the questions we asked. This is our understanding based on your answers. We'll make sure that they reply in the affirmative. Once we're all on the same page, hopefully at that point we'll know if Congress is doing something or nothing. And if it's something, then that's great. You can lower the amount of investment. If it's nothing, I would go in with the 134. I'd take a very large deduction in year one. And now there are a number of things that can happen between year one and year five. So the bonus depreciation under current law is 60% of the assets placed in service in year one, 40% in year two, in year 2025, 20% in 2026, and it's scheduled to phase out. Now, that's if the law doesn't pass. Now, there is a separate section, and you hit the nail on the head, section 179. That's that's your holy grail. What happens in 2029 if it were me, right, and I were facing a $494,000 of income? I would say, thanks for paying this off. I really like the program. I'd like to re-up. I'm going to put more equipment into play. And Section 179 lets you depreciate up to 100% of the value of the assets placed in service. But unlike Section 168 that lets you generate a loss, Section 179 will only let you go down to zero, not below it. So what I would do is I would elect under Section 179, bring my income down to zero, elect my 10% per year for the next 5 years, and then I'd rinse and repeat. Because it's essentially free money. It's going to be their purchase price plus the payment on the principal here. Um, of course, you've got your interest deduction, and it's going to be a combination of our numbers here. Plus, there's a little bit of depreciation left in year nine. So if I take the debt service and I take the principal and I deduct the interest and I deduct the depreciation and I add the repurchase amount, that's how I get my 494, 484. Oh, for sure, yes. Right. Correct. We're reducing you should end up with a refund of $218,000, right? Now, I'm netting that with 134 to get the 84, but that $218,000 you get back, you know, that's just free money to invest. So even if you invested at 5% per year, by the time it comes to pay your dues, if you decide not to re-up and just pay it, you're still earning money on that. No, no, that would be taxable income. At your tax rate, I don't know what your tax rate is. 43.85. Well, not quite, because you're gonna have a different New York number. So yeah, your liability would be 182, right? In 2029. Save a little bit here. You've got a little bit of income leakage in 26, 27, 28. What our clients tend to do is they will tend to do this every other year, right? So the year one, you got a loss in 24, a loss in 25, then they'll do this again in 2026 and they'll generate a loss. Now, if you were doing this in an era where there was no bonus depreciation, this is what it would look like. You'd have essentially 5 years of losses followed by 1 year of 5 years of losses followed by 1 year of income. But the bonus really amps it up, and it lets you get a big deduction in 24. Correct. You're investing 134 and you've got 800,000 of debt. Uh, right. Yeah. So you're buying $895,000 worth of assets, and that allows us to get this 60% deduction. All right, fun stuff. So here's what I'm going to do. I'm going to go ahead and send you these calculations. I will send you this presentation. There are a bunch of uh, taxation of investment slides. I would read those at your leisure. I'm not an investment guy. I can talk tax on investments, but nobody likes to hear that. So I'll send you the slides. I'll send you the presentation, and I will ask our office to send you an engagement letter so you can see what that looks like. And if you have any questions, we can schedule a follow-up call. And if we don't hear from you in about a week, we'll unleash Mohini to reach out to you. It is for 2024, yes. Mhm. Yeah, if you haven't if you engage us, yeah, if you engage us, we'll go ahead and file your 2020. Please file your extension today. I believe don't hold me to this. I'd have to look. I believe New York accepts the federal extension. Um, let me look while we're on the phone. I apologize. I should know that off the top of my head. Uh, let's see. Well, what the heck? New York does not recognize the federal extension. Huh? What do you know? But they yes, correct. But the if you go to the Department of Tax and Finance, if you just Google that, New York Department of Tax and Finance, there will be a section there somewhere that will allow you to file an extension electronically online for free. The other thing you could do is just print and mail the forms, but I'd mail them certified mail. It is the New York Department of Tax and Finance. Let's apply for. Yes. Here, let me. Going to share a different screen with you. Find my different screen to share. There we go. And you should see. You go if you just Google. I googled. You just Google like a New York extension. You'll end up on this page. And if you just go down, request an extension, you probably don't need to make a payment. You've probably had everything deducted. So you just select individual, married joint, special condition, done, and then continue. Then it's going to ask you for your social, name, address, and it's fast and it's free. Um, for IRS purposes, I would file the form. And if you want, what I can do is, you know what I'll do is what I said when I send you these presentations, I'm just going to go and I'll send you the link to get to the New York page, and I'll send you a link to get to the correct IRS form. All right, sir. Yeah, federal and New York are going to have to be separate. Yeah, that's all part of our fee. We don't charge by the form. We don't charge by the hour. It's a flat $15,000. It's a 12-month engagement. We'd start, you know, by grabbing information and filing your 2023 return. And if all goes well before the engagement's done, we'll also have your 24 return filed. Fantastic. Yep. Mhm. Absolutely. Yep. Unless you're telling me that there's a divorce pending, we shouldn't have any complications. Okay. Fantastic. All right. Yeah. Thanks for your time today. Sorry I ran a bit over. All right. Thank you. Goodbye.